For years, markets have learned to shrug off warnings. A recession, it gets delayed. Inflation, it cools. Bank stress, it gets contained. But when Jamie Dimon speaks, Wall Street does not ignore it. Because Jamie Dimon is not a television pundit. He is not a social media economist. He's the longtime CEO of JPMorgan Chase, the largest bank in the United States by assets, and one of the most influential voices in global finance. And recently, his tone has shifted, not toward panic, not toward dramatic predictions, but towards something arguably more serious. Caution. Dimon has been warning that the U.S. economy may be walking into a far more complex environment than most investors are pricing in. He has repeatedly said that the risks ahead are extraordinary, that geopolitical tensions are rising, that inflation may prove stickier than expected, and that markets are showing a level of complacency that does not match reality. That word complacency matters, because after more than a decade of low interest rates, strong equity returns, and repeated central bank rescues, many investors have come to believe that volatility is temporary and downturns are buying opportunities. Dimon is questioning that mindset. He has warned that inflation may not simply glide back down to 2% and stay there. Even after the Federal Reserve's aggressive tightening cycle, inflation pressures have proven persistent in certain sectors. Wage growth remains elevated in parts of the economy. Fiscal spending continues at high levels. And here's the uncomfortable part. The USC, while moderating, is still positive. Historically, deficits tend to surge during recessions, not during expansions. Yet the federal deficit has expanded significantly even without a major economic contraction. That means debt levels continue to rise rapidly. Dimon has pointed out that the scale of U.S. government borrowing is unprecedented outside of wartime or deep recession, and that creates long-term risks for interest rates, bond markets, and financial stability. Think about what that means. When the government borrows heavily, it issues large quantities of treasury bonds. Those bonds must be absorbed by investors, domestic and foreign. If demand weakens, yields rise. If yields rise, borrowing costs across the entire economy increase. Mortgages become more expensive. Corporate loans become more expensive. Credit card rates climb. Small business financing tightens. Higher rates ripple everywhere. Now here's where Dimon's warning becomes sharper. He has repeatedly emphasized that markets may be underestimating the possibility that interest rates stay higher for longer or even rise further. Many investors assume that the Federal Reserve will eventually cut rates aggressively to support growth. But if inflation proves sticky, the central bank may not have that flexibility. And if rates remain elevated while debt levels are high, stress builds. Not necessarily in dramatic fashion overnight, but gradually. Banks tighten lending standards. Consumers reduce discretionary spending. Companies delay expansion. Commercial real estate valuations struggle under refinancing pressure. Regional lenders face margin compression. Private equity deals become harder to finance. None of this looks like a single explosive event. It looks like friction spreading through the system. Dimon has also warned about geopolitical risks. Conflicts in Europe and the Middle East, rising tensions between major powers, and supply chain realignments all create uncertainty. Energy markets, trade routes, and commodity flows can shift quickly in times of conflict. If you combine high government debt, elevated interest rates, persistent inflation risk, and geopolitical instability, you get a fragile environment. And yet, equity markets have often traded near record highs. That disconnect is what concerns him. He has described the current moment as potentially one of the most dangerous geopolitical and economic periods in decades. That does not mean a crash is guaranteed. It means the range of possible outcomes is wider than investors assume. Let me ask you something. When was the last time markets truly priced in worst-case scenarios? In 2006, housing looked stable until it wasn't. In early 2020, global growth looked steady until a pandemic shut down the world in weeks. Dimon's broader message is not panic now. It is do not assume stability is permanent. He has stressed the importance of resilience for banks, for corporations, and for households. JPMorgan has built capital buffers well above regulatory minimums. It has maintained liquidity to withstand shocks. Dimon frequently talks about preparing for extreme but plausible outcomes. That mindset shaped the bank's role during recent regional bank failures, when JPMorgan stepped in to acquire assets and help stabilize parts of the system. But resilience at one institution does not eliminate systemic risk. Another major concern Dimon has raised is the unwinding of quantitative easing. For years, central banks injected trillions into financial markets, purchasing government bonds and mortgage-backed securities that supported asset prices and compressed yields. Now, quantitative tightening is reversing that process. Liquidity is like oxygen in financial markets. You do not notice it when it is abundant. You feel it immediately when it tightens. Dimon has suggested that markets may not fully understand how this long-term liquidity shift will play out. At the same time, consumer strength, which has been a pillar of USA economic resilience, may not be as durable as headline data suggests. Pandemic-era savings have largely been spent down. Credit card balances have climbed. Delinquency rates, while not alarming at a systemic level, have shown signs of normalization upward. If labor markets soften even modestly, consumer spending could cool more sharply than expected. And remember, consumer spending drives roughly 2/3 of U.S. GDP. So when Dimon says the economy could face turbulence, he's not speaking in abstractions. He's looking at interconnected pressures: high debt, high rates, persistent inflation risk, geopolitical uncertainty, liquidity withdrawal. Now imagine one more shock layered on top: an energy spike, a policy mistake, a global conflict escalation. The margin for error narrows. But here's where the story becomes more nuanced. Dimon has also acknowledged that the U.S. economy has shown remarkable resilience. Job growth has been steady. Corporate earnings have generally held up. The banking system, broadly speaking, is well capitalized compared to pre-2008 levels. Innovation continues across technology, energy, and manufacturing sectors. This is not a collapse narrative. It is a probability narrative. He is essentially saying that downside risks are larger than markets assume, and that policymakers must take fiscal discipline seriously before bond markets force harsher adjustments. Because once markets lose confidence in fiscal trajectories, adjustments can become abrupt. Look at other advanced economies that have faced sudden bond market pressure after fiscal missteps. Currency weakness, yield spikes, emergency central bank interventions. These things can happen quickly. The United States benefits from the dollar's reserve currency status. That provides significant flexibility, but it does not grant immunity. Dimon has been clear that long-term prosperity requires responsible budgeting, infrastructure investment, energy security, and geopolitical stability. And here's the line that should make you think. He has warned that the next recession, whenever it comes, could be more complicated than the last one. Why? Because in 2008, the problem was concentrated in housing and leveraged financial products. In 2020, the shock was external and met with massive coordinated stimulus. The next downturn, if it happens in a high-debt, high-rate world, may leave policymakers with fewer easy tools. Cutting rates aggressively could reignite inflation. Spending aggressively could worsen deficits and bond pressures. Printing money could undermine currency stability. Choices become trade-offs. If you're still watching at this point, consider your own exposure. Are your investments heavily concentrated in rate-sensitive assets? Are you assuming quick rate cuts will rescue markets? Are you relying on perpetual asset appreciation to fund long-term goals? Dimon's underlying message is about preparation. He has repeatedly said that institutions must prepare for scenarios that may not be consensus expectations. That includes stagflation, a combination of slow growth and persistent inflation. It includes geopolitical escalations. It includes bond market volatility. Stagflation is particularly uncomfortable because it limits policy flexibility. Central banks cannot stimulate aggressively without worsening inflation. Governments cannot borrow freely without pushing yields higher. And markets hate uncertainty. The late 2010s trained investors to expect low volatility and supportive monetary policy. The 2020s are shaping up differently. Dimon is asking a simple question. What if that optimism is underestimating the complexity ahead? Because by the time risks become obvious, markets will have already adjusted. and adjustments are rarely gentle. So the real takeaway is not fear. It is awareness. Awareness that debt matters. Awareness that rates matter. Awareness that rates matter. Awareness that geopolitics matters. Awareness that liquidity conditions matter. And awareness that preparation during stability is always easier than adaptation during crisis. Jamie Dimon has spent decades navigating financial storms. When he signals that the clouds on the horizon look heavier than usual, it is worth paying attention, not because disaster is certain, but because uncertainty is rising. And in finance, rising uncertainty changes everything.